Differences between finance and accounting. Finance versus accounting. Finance is the study of the management of funds in the best possible manner, whereas accounting is a methodical record-keeping of transactions of business. Finance is the part of economics and not part of accounting, whereas accounting is the part of finance. The purpose of finance is to forecast the future performance of the business, whereas the purpose of accounting is to see how the company is performing, to monitor day-to-day operations, accounting operations, and for taxing. Finance mainly focuses on future, whereas accounting mainly focuses in past. Finance is concerned with understanding financial data of the enterprise, keeping in mind the growth and strategy, whereas accounting is concerned with ensuring that all the financial transactions are recorded in the financial system with accuracy. Thinking process of finance is analysis-based, whereas thinking process of accounting is rules-based. Financial statements are analyzed in finance, whereas financial statements are prepared in accounting. Finance is based on plan-driven, whereas accounting is based on tax-driven. Treasurers are engaged in decision-making on prepared financial status of firm, whereas controller are engaged in preparation of financial status of firms. Treasurer is overseeing the finance department, whereas controller is in charge of the accounting department. Finance professionals can become financial managers, treasurers, investment bankers, financial analysts, finance consultants, etc., whereas accounting professionals can become controllers, accountants, auditors, tax consultants, accounts receivable clerk, accounts payable clerk, etc. Finance is inherently forward-looking. All value of organization comes from the future, whereas accounting provides a snapshot of an organization's financial situation using past and present transactional data. Finance rejects accrual method idea, instead believing that the best way to measure economic returns from a company is to calculate the cash it's able to produce and leverage, which is dependent on when that cash is exchanged, rather than just agreed upon. Whereas the accrual method of accounting, which is followed by most organizations, records transactions as they are agreed upon, as opposed to when they are completed. It allows for transactions to be made with credit or deferred payments, and operates under the idea that revenues and costs will smooth out over time to more accurately depict economic reality. This makes it possible to compare year-on-year growth of a company's revenues, costs, and profits without factoring in one-off events, as well as seasonal and cyclical changes. This is handled much differently in finance, which employs an analytical process, known as valuation, to determine the worth of a company, project, or asset. The gold standard is discounted cash flow analysis, which is applied to a series of cash flows over a period of time. The discount rate, represented as a percentage, accounts for opportunity cost, inflation, and risk, and brings the value of a future stream of cash to its present value. Whereas, in accounting, a conservatism principle is often applied, which suggests that companies should record lower projected values of their assets and higher estimates of their liabilities. Under this doctrine, if you don't know the value of something precisely, you count it as zero. Doing so helps businesses avoid overextending themselves by underestimating the value of assets and overestimating the liabilities that they owe. In short, finance is the art and science of managing money. Finance is the study of money in capital markets, which often encompasses many activities such as investing, borrowing, lending, budgeting, and forecasting. It is the management and control of assets and investments which focuses on decisions of individual, financial, and other institutions as they select securities for investment portfolios. Thus, finance is the study of money in capital markets. It is the management and control of assets and investments which emphasizes on decisions of individual, financial, and other institutions as they select securities for investment portfolios. Whereas accounting is the practice of preparing accounting records including measuring, preparation, analyzing and interpretations of financial statements. These records are used to develop and provide data measuring the performance of firm, assessing its financial position and paying taxes. In accounting, insight into a firm's financial situation is gained through the accounting equation, which is assets is equal to liabilities plus owner's equity. This formula looks at what a company owns, its assets, what it owes, its liabilities, and the residual that belongs to shareholders, owner's equity. Thus, accounting is a system of making records, verifications and reporting of value of assets, liabilities, owner equities, sales revenues, expenses and income in the book of accounts. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.